Stocks and bonds rallied yesterday as Jerome Powell said a lot of things, but investors wanted to hear that the recent jump in the US inflation didn't materially change their policy outlook. Elsewhere, gold's renewed record and US crude extended gains past the $86 per barrel level as OPEC confirmed that it will maintain its supply cuts in place for the coming months. So welcome, this is Swissquote's Daily Market Talk. Investors prefer to overweight the dovish messages and underweight the hawkish ones from the Federal Reserve and of course other central banks as well, because it is obviously soothing to think that the Fed and the other central banks are on their side, on investors' side, than against them. And this tendency is very, very clear these days as the economic data challenges the Fed does, and we receive mixed messages from the Fed members and mixed messages even within the speech of a single member. So what do people do? Well, they choose what they want to hear. So in this respect, the Fed Chair Jerome Powell reiterated yesterday that the Federal Reserve is not in a rush to cut the interest rates, but that the Fed will cut the rates sometime this year, and that the recent jump in inflation in the US didn't materially change their policy outlook. But look, yesterday we saw yet another hotter than expected data point from the US. The ADP printed 184,000 new private job additions in the US last month, while the ISM's non-manufacturing activity expanded, though we also saw employment and prices components of the ISM index print lower than expected numbers that actually do back a softer Fed. Yet, earlier this week, the ISM's manufacturing index, which was in the contraction zone for 16 months, jumped into the expansion zone and prices there accelerated faster. And the Atlanta Fed's GDP now forecast points at a first quarter growth of 2.8%. So the Fed may not feel the hurry to cut the interest rates, but the market thinks it should be, even though the data is strong, if it doesn't want to be part of the November's US election story. So the challenge is big for the Fed, because either the Fed will cut the interest rates by early summer and take the risk of seeing inflation in the US pick up momentum into the year end, or it will wait until after the presidential election and take the risk of imposing an otherwise unnecessary pressure on the US economy. Now, obviously, to make things easy, we will say that the economic data should decide. But the markets and investors don't react fully to the economic data when the Federal Reserve members are out there and continuing to keep the dovish talk on the table. And those who tell otherwise, well, go completely unheard. Because, well, the Fed's Raphael Bostic also spoke yesterday, and he said that he expects just one rate cut from the Fed this year, and that after the election. So as a result, well, the US 2-year yield eased yesterday as Jerome Powell stressed out that the recent rise in inflation doesn't materially change the way the Fed sees things, meaning 3 rate cuts from the Fed this year as per their latest dot plot, and the US 10-year yield eased to the 4.36% level. The US dollar index sharply retreated yesterday, and the S&P 500 rebounded, although the semiconductors came under a certain selling pressure yesterday after a strong earthquake hit Taiwan and brought TSM to halt its operations on the island. Now, TSM is a major supplier of big names like Apple and Nvidia, and they produce around 80 to 90% of their high-end chips on the island. Now, they do have plans to diversify geographically to Japan and US, but for now, what happens on the island and Taiwan has an impact on the global mood. So therefore, Nvidia shares saw a small retreat yesterday of 0.55%. But the good news is that, well, TSM said that it will resume its operations quite quickly, as happily their critical tools have not been damaged by this week's earthquake. Up next, well, investors will be watching this weekly jobless claims from the US and job cuts numbers as they wait for Friday's most important jobs data. Now, the sharp decline in the US dollar sent the euro dollar sharply higher yesterday as well. The pair made a quick move to 108.45 level after testing the 107.40 level to the downside at the start of this week and quarter. But fundamentally speaking, the data was supportive of the euro bears yesterday because inflation in the eurozone is more than expected. In numbers, the headline number fell from 2.6 to 2.4% versus 2.5% expected by analysts, while core inflation fell from 3.1 to 2.9% versus a decline to 3% penciled in by analysts. The unemployment rate, on the other hand, remained steady at 6.5% level versus an improvement to 6.4% expected by analysts. So the data, the lower than expected inflation and higher than expected unemployment, clearly cemented the expectation of a June rate cut from the European Central Bank, but couldn't give the euro bears enough leverage to fight against such a strong decline that we saw in the US dollar. And across the channel, the Bank of England, those are also gaining the upper hand on the Fed, those, because according to Bloomberg, the probability of a Bank of England rate cut stood at 67% yesterday for a June rate cut versus just 57% for the Fed. But you couldn't see that pricing on a cable chart where the pair rebounded in a sharp move at yesterday's trading session due to the US dollar weakness, but keeping the economic data on both sides of the Atlantic Ocean in perspective, I actually think that it makes more sense selling the tops in both the euro and sterling against the US dollar than buying the dips. Now, in the commodities space, the crude oil rally accelerated yesterday after the US crude cleared the $85 per barrel level. The barrel of US crude traded at $86.50 per barrel after OPEC confirmed to maintain supply cuts in place for the next few months. And while the US oil inventories, on the other hand, jumped more than 3 million barrels last week. So it's important to note at this point that we could have actually seen a test of the $85 per barrel resistance and a correction to the downside because the extension of OPEC cuts were already made public and priced in, and also because, well, US oil inventories rose more than expected last week, but the market decided to carry this oil rally higher, meaning that the trend in oil market is strongly on the bull side these days, which obviously means that the oil rally certainly has more room to extend toward the $88 to $90 per barrel range. In precious metals, well, gold continues to run from record to record. The price of an ounce exceeded the $2,300 level per ounce at yesterday's trading session on the back of softer US dollar and the falling US yields. Now, maybe, but just maybe, some investors are seeking refuge in the safe haven gold as the geopolitical scene remains quite tense these days, and all the sustainability of the equity rally is also questioned. But note that the RSI indicator on the gold chart warns that gold has been bought too rapidly and in a too short period of time, and that the overbought conditions that we see on the gold chart could actually trigger a certain downside correction in prices. But interestingly, I need to tell you this because we were shooting the quarterly market outlook video with NFG partners Glenn Coxon yesterday, and he interestingly highlighted the fact that gold traders are more trend followers than the traders of other assets like Nasdaq, for example, and that the positive trend in gold could extend if we don't see a sizable downside correction that could eventually get the holders of long gold positions to call the end of the positive trend. So that means that above a certain price level, and psychological levels are clearly important in this context, while traders will continue to buy the dips. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.